Good morning, Pete.
Good morning, Don. And you are our philanthropic advisor. And how did you become a philanthropic advisor, by the way?
You made me do it. No. What had happened was we wound up in a situation of selling a building, and for the good news was it had made a lot of money. The bad news was made a lot of taxes, and I accidentally ran into you because we knew each other, and we were going off to visit a friend, and you discussed charitable giving, and we figured out that made more sense. And then I decided, being the bean counter that I am, that what I should do is go back and study all of this. And so that's how I wound up going back and getting into it. What I think we ought to do, however, so FOW doesn't beat up on us later on, is this is financial and estate literacy. This is it's your estate. This is week 5, and we're going to talk about charitable giving. So we can continue the discussion now, Pete, because we've actually done the intro, and that will make FOW happier.
Well, this session is it's one of my favorites. And the reason why it's one of my favorites is because most professionals, stockbrokers, financial advisors, attorneys, CPAs, literally don't know this area. And when people think of giving your money away, they don't think of that it could be of any economic advantage.
Right.
And yeah, it can be. And so one of the things I love about you, John, is that you actually took the time, learned this stuff. You're a bean counter, ran the numbers, and it makes sense. It made sense for you.
Right.
And so let's get started. By the way, do you sell product or anything like that?
Why don't we discuss my my ask first in just a moment, Pete?
Okay, let's do it.
So there's that. Okay. So what we have is Pete's leading into this document. So yes, Pete, I have a master's degree with an emphasis in international business. I've been a CPA for 30 years, roughly, probably more than that. I don't know. CPA license, if you really wanted to find out my license, any information about me, it will be very boring because I don't actually practice as a CPA, but I do have a license and I keep it active for a variety of reasons.
And then scroll down.
Wait a minute, I don't provide legal services. So we need to talk about that one while we're there, because then when we scroll down, we're going to get the other half of the form, making it a little bit larger than the other. So my relationship is strictly with clients. I don't sell anything. I don't offer any services other than knowledge. And so it really is strictly for the individual. As someone made the comment one time of, well, if you're helping someone look at charity, don't you recommend charities? No, I'm agnostic in terms of what charity I would recommend it, because it's up to the individual. It isn't my choice. I hope they choose to give, but beyond that, it's completely within their control.
And how do you get paid?
I don't get paid. Because of your recommendation in terms of the charitable giving that we did, I'm in a position where I don't want to get paid. I don't need to get paid. So what I do is to say, I'd love to help someone. And after a while, if this gets really complicated and we spend a lot of time together working on it, I'm going to tell you that you need to write a check to a charity and give it to them. And you don't need to give me a canceled check to prove that you did it. It's the honor system. But personally, I don't want to receive anything for doing the work, because to me, it's to charity, and that's where it should go.
Okay, let's get into.
And no, I have no affiliated associations other than I know you. And yes, I've signed it. And the hardest part about filling out this form is figuring out how to do it on a computer and get it to line up the way you want to. I noticed yesterday's presentation, they'd gone through and written it in, which made sense. Okay, so why are we doing this? Pete's alluded to the fact of, you can give and you get back, and what do you do? But let's first talk about charitable giving in terms of when and what type, because there are differences involved in that. If you give to charity today while you're alive, we're assuming you're alive if you're watching the Zoom session, otherwise you had a hard time logging in. So while you're alive, if you give to charity and you get nothing in return other than a nice thank you letter or something else, you don't get tickets to the gala, you don't get nice seats at the Laker game, you don't get anything else with it, you can take a deduction for that from your income tax. You can deduct it up to 60% of your what's called adjusted gross income, AGI. For cash donation, that's 60% of that in a given year. If it was appreciated stock, it's 30% in any given year. You can deduct that because you may not use it all up in one year, for the current year plus 5 additional years. You do need to itemize deduction for this. So if you're using a standard deduction and see no reason to change from it, you may not get as much of a tax deduction other than a QCD, which we'll talk about in just a little bit. So that's one side of this. If you give to charity today and you do get tickets to the Laker game, then the net value of what you gave is what is deductible. And normally, for instance, we did a charitable remainder trust. We will get income for the rest of our lives. And while we get that, that's not tax deductible. So they take the net present value of that and you get the difference of this one. So we gave this much money and we got that much as a charitable deduction, which was a nice deduction, but you don't get 100% of it. If you wait until you die, then the same rules apply, but it's your estate that gets it. And today, when we're almost at $13 million in exemption each, probably your estate doesn't care about this, or you have a very large estate and you're giving a lot of money away, which is delightful too. So that's sort of where these kinds of things fit in.
So today, with the standard deduction, most individuals are not too concerned with the deduction.
They're not doing it for only for tax deductible purposes. Yeah. They're doing it because it's a good philanthropic thing to do. And statistically, we can prove to you that you will live longer if you give money away to charity, but that's where that is. So,
and most people give cash, and we'll talk a little bit about that's probably the worst thing to give.
So other than, whoops, I lost that. There it is. Other than tax deductions, there probably could be some issues you want to solve. You want to give back, and that's the philanthropic side of this, and that's a lovely thing. Income tax. You want to avoid taxation today. You want to defer it for later. You want a tax deduction if you're itemizing. You may have capital gains. In our case, we were selling a building. We had a very large capital gain on it, but I wanted to defer that. So by giving it to charity, I don't have to pay the tax now. It is calculated out of what I receive over a long period of time. We have a lot of people who've gone through and done what's called a 1031 exchange. They have rental property. They sold this property, 1031 exchange into a new one, don't have to pay any tax on any gain until they have the last 1031 exchange, and then it's taxable all the way back through that. So that's a big thing if you have rental property, is how do I get out of the rental property without getting killed in taxes? And that's where charity can help out. The other is estate tax. Again, with the high exemption, you may not care today. That really isn't as much of a thing to most people. And so gifting today, or what's called portability, if I die today, Jean will probably be sad, but we'll skip over that part of it. But whatever isn't used in my exemption, she can claim portability and add it to hers. So just because I've died doesn't mean it all goes away. That's called portability. And it's very important for people to do that. The other thing is, after 2025, this almost $13 million deduction could go to 5. And at 5 million, there's more of us who could have estate tax. And so that's an issue. And that's where portability is very important in terms of what's going on. The other part of that is cash flow. Do I have cash flow today? And I love to talk about Berkshire Hathaway. What a wonderful company. What incredible growth that they have had over all these years. But there's a funny thing about Buffett. He doesn't like giving away money, so he doesn't pay dividends. So you may have wonderful increase in value, but to get money out of it, you have to pay capital gains or give it to charity. They don't pay capital gains. So that's where cash flow today or tomorrow, and really looking at your beneficiaries of what you want, all of those you can use charity for. Investments, there are people who, I was at Google when they started and got my stock at each amount of money, and now it's worth a lot. Or Pete likes to say he bought Apple stock at 10, and it's ever so slightly larger today. And so how do you get out of it? One, is it growing like Berkshire Hathaway? Are it just gains? Are you tired of the volatility of the market because that's a little scary this year and last year? And where do all these other things work out? Last is beneficiaries. It isn't just about what we have today, what we're living on. It also is, what do you want to give to your family or to others from a beneficiary standpoint? Is there a special needs trust of some kind? That may be medical, it may be bad habits. Do we have an issue of spending too much? Do we have people in love with chemical dependency? And how do you manage that? And are they going to go blow all the money when they first get it, if that's where you put it? So all of these things are things that can be dealt with within charity. Yes,
I love Don. I love the way you put this. That besides the fact of that, charity is just philanthropic. It could really solve some issues.
a lot of them.
The example of the Apple stock not giving any income. You could literally sell it for tax-free and then spread your tax deferral over your lifetime.
Right. Yes.
We're going to talk probably a little bit about beneficiaries.
Yes.
Well, in what we learn in the retirement planning area is that you have 10 years of a stretch. Well, with a charitable remainder trust.
And in fact, we can discuss that right now. Good lead, Pete. Thank you.
Well, I just wanted to get this charitable area can solve problems.
Yes. Yeah.
Besides being philanthropic. And
right.
That's what I love about it.
Yeah. Yeah. So there's a concept called income in respect of decedent. I have an IRA account. And I'll show you in a minute that when I take money out of that, I pay tax at an ordinary tax rate. If I die, whoever gets that money, gets that account, has to do the same thing. It's in respect of decedent. If I had to pay it, you have to pay it when you get it as a beneficiary. So how do you deal with those kinds of things? And in something like an IRA or a 401k or 403b, you paid no tax when you went in. So it was a tax deduction going in. They want the money on the back end, and that's why the IRS is going, we need our money back. We need it and we want it back both. And therefore, that's how we're going to tax it. So for those of us who are over 73 and above, it's going to get older later on, but we would have to get to 2033 to become 75. And since 2 days ago, I became 74, it doesn't matter to me. I'm already tagged. You have to take out a required minimum distribution. If you don't take that out, there's a miserable fine that you pay on top of the tax that you would have to pay. So it's very difficult. It's very painful if you don't pay attention to required minimum distribution. Required minimum distribution is based on what was in your account January 1 or December 31 of last year times a factor, which is your age. So it's the value of the account plus a factor, and that change, they both change each year. So the account's going to go up and down, and your age is generally only going up, but we'll look at that. The reason this becomes important in part is because whatever you take out is ordinary taxable income. Now you can look at this as I do and say, wait a minute, there's capital gains in there. They don't care. You didn't pay tax when you went in. Now, if you have a Roth account, that's a different animal in terms of how you look at it. But on these taxable accounts, those are retirement accounts. Those are ones that are going to come out as ordinary income. So in this case, as an example, I can look over here and for whatever reason, I don't know why, I pick on 80-year-olds. And in this case, their factor is 20.2. So if as of the beginning of the year, you had, where's my mouse? 500,000, your age is 80, you divide by 20.2, and you have $24,752 that you have to take out as an RMD if you are 73 or above, okay? And if you don't, nasty penalties. And as you can see, and this, I have rates in here that are 5-year jumps, but it's actually every year it changes. So these are the factors along the way. The larger the factor, the less you have to take out. So if you was 90, you divide by 12.1 and it would be more money out. They seem to think the older you get, the more they want it before you go away and not do this. There's a concept called qualified charitable distribution. I'm going to keep referring to it as a QCD because I'll get messed up in the word names later on. So I'm just going to call it a QCD. If you are over 70 and a half, why they didn't make these consistent, I don't know or care. But if you're over 70 and a half, you can take out your required minimum distribution and give it directly to charity. By giving it directly to charity, you pay no tax. So 100% deductible, whether or not you have itemized deduction. So if I have a standard deduction, I can't take this. Yes, you can. Because what happens at the end of the year is whoever your broker is or whoever holds your account, they're going to send you what's called a 1099-R, which says you owe $24,752. But if you do a qualified charitable distribution for part of that, you don't have to pay tax on that part. So let's look at that. So as an example, if you did a $15,000 rollover, we'll call it, which says I gave $15,000 to charity, then the only tax you would pay is on $9,752. So you've just saved $3,000 in taxes. Because at $15,000 at 20%, you would have paid $30,000. And you may be at a higher tax rate than 20%. So that's what saves you money. Now, I understand and completely agree. If you need the money from the RMD, keep the money. Don't worry about it. This is if you have an option that you don't need the money. But I want to show you something that's important. Let's say you had an RMD of $25,000. If you gave $20,000, a slightly different example, if you gave 20 to charity, then you'd only be taxed on the 5% or $1,000 at this 20% rate. Pay $1,000 in taxes. If not, you would have paid 20% of the entire 25, and you've just saved $4,000. So percent taxed, incidentally, raises your Social Security rate that you get taxed at, raises your Medicare tax fee that you're going to be paying, and it winds up, you've just lost $4,000. So, but if you want to give the $20,000 to charity after the fact, you're going to wind up having to take out the $25,000. If you give the 20 away, you're going to have to take more money out because you pay tax on the money you're taking out. Therefore, that's after tax, and they're going to tax the whole thing. So you wind up getting hurt. If you're going to give the 20, give it, but do it out of a QCD. My suggestion is you have to have the check payable to the charity. You do not have to have it mailed to the charity. What we do is, these are the charity, and you can do one or more, whatever. I mean, we do, the last year, I think we did 6 or 8 different charities that we gave to between Gene and I. Have them mail you the check. You get the check. What I do is I make a copy of it. Now I have proof that I did it. And then I also put that in an envelope, address it to the charity, and put in a note that it's from us. Because the charity gets it, and I really have no idea who it's from. And why not get credit for doing it? So you can send them that note and tell them this is from me. That way you can tell your TurboTax, if you're doing your own taxes, or your tax advisor, here's how you do it. Another example. Go ahead.
I just want to, the QCD is not everybody knows about it. I mean,
no.
I just had in the workshop the other day, a lady came up to me and said, my tax accountant had no clue about the QCD.
Right.
So if you're 70 and a half and over, you really need to almost 100% look at this as the way to make your donations. Talk a little bit about this church example.
Incidentally, let me make one point. And Pete's absolutely correct. A lot of people don't understand this or have heard of it. And I'm going to give you a recommendation. I don't have a copy of it. If you look at your statement from your broker, and you probably have to go to almost the last page. On ours, and both, we have different brokers that handle our accounts, but the statement has it in the same place. There's this little tiny section that says required minimum distribution. And if in my case, I had to start last year, the year before, whenever it was. So it said, this is what it was last year, and you paid it. This year, this is how much you have to pay. So it tells you what you have to take out. You don't have to go through all that math I just did. That's how they get to the number. But it tells you what you're going to owe. So it's criminal, inappropriate, whatever term you want to use, but a tax advisor wouldn't know about a QCD. Now, if you're 65, you don't know, they don't know about it because you don't care. If you're 73, you really care because you're taking a required minimum. The church example, for the sake of discussion, you give $50 a week to your church. Whether that's high or low, doesn't matter to me at the moment. That's $2,600 a year. You'd have to take out $3,250 out of your retirement account to pay that $2,600 because of the tax. 20% tax. If you took out 3,250, you could pay 650 in tax. That brings you down to 2,600. So by just having the QCD, you could say take it out weekly, or you could go to the church and say, I'll tell you what, I'm going to give you a check once a year for $2,600. And they're going to say, thank you. That's very nice of you. Not, well, no, we only want it weekly. No, they don't. They want it all the time. If you use the QCD and paid it directly, you would have just saved $650. Something
And
that's
the
simple.
Medicare, the
and if
Medicare.
And if you want two things, one, Medicare may go down, and the tax rate that you have to pay on Social Security will not go up by this 2,600. And if you want to give the additional 650 to your church, they'd love you to do that. But you can keep the 650 and give them the 2,600, and that's the way it works. And it's very simple.
And your maximum is 100,000. There is no minimum. So, you know, I would say probably just from a administrative point, you may want to do it a minimum of $100, and there's no limit on the number of charities.
No,
but I would also recommend that you pick your favorite 3 to 5 charities and give them a little bit more, have an impact on that charitable organization.
Yeah. And to Pete's point, in terms of you can have up to $100,000 that you can have in a QCD, they're limited to that. So if you had $4 or $5 million in your account, you might hit that limit. Most of us don't hit that limit. Yeah. Pete does, I'm sure, but most of us don't.
Well, I'll tell you a little secret. The way I fund financial and estate literacy is literally through QCD.
Right.
You know? That's
because financial estate literacy is a
501c3.
And in fact, they're one of the ones I believe we contributed to also, which is the only reason you invite me back. The other thing that's important about a QCD is, well, 2 things. One, you can't give it to a donor advised fund, which we'll talk about later. It has to be an operating charity. So it has to be a 501c3 operating charity. That's one. The other is they changed it last year. There's a thing called a charitable gift annuity. And while on the financial side of these, we talk about, oh my God, don't do an annuity. That's a commercial annuity. Charitable gift annuity is a different animal. You are allowed to take up to $50,000 on a QCD and put it into a charitable gift annuity. You can also do a charitable remainder trust, but honestly, that's not worth the money. Charitable gift annuity, you can give it one time to a charitable gift annuity and set that up with a university or a community foundation or some other large. I have someone next door doing their gardening. So charitable gift annuity, which we'll talk about more, but it ties into that QCD because you could put up to 50,000 into a QCD. Okay, what's a charitable gift annuity? So there's a group called the American Council on Gift Annuities, catchy title, that basically says if you're a charity and you want to do these charitable gift annuities where people give you money, we should all give the same rate. So that there isn't, oh, gee, the Heart Association is going to pay me a little bit more money. I should give it to them or something else. So most charities follow that agreement. You can say, well, this is a monopoly. They don't have to follow it. There are 2 large universities on the East Coast who feel they can make more money and therefore will pay you more money if you'd like to give the money to them. Okay, that's fine.
Slightly higher, not much.
No, not much. So I use as an example Chapman University because Chapman has been a sponsor of ours for a long time, and they're very good in terms of handling a lot of these kinds of issues. If you went to Chapman and said, I want to give a charitable gift annuity, whether it's from a QCD or just give them an amount of money, how do we handle this and what goes on? You go in and based on your rate, again, I'm going to pick on my 80-year-old, you will get 7.6% interest on the money you give for the rest of your life. And if there's 2 of you, for both of your lives, you'll get 7.6%. It does not adjust with inflation. It doesn't change. It's not like the RMD, which floats back and forth. You're going to get 7.6% on the money you put in. And I'll show you an example of that in just a minute. I will say up front, it is irrevocable. Once you have done this, you aren't going to be able to go back in 5 years and say, I'd really like my money back. No, they've been paying you money along the way. So it is irrevocable, but it's like a 2-page form and no sales pressure, no anything else. They'd be happy to talk to you about it. Whenever you're ready, they'd be happy to move forward if you wish to. So that's there. The charity, let's say Chapman in this case, it's regulated by the insurance commissioner in the state of California, as an example, by the insurance commissioner. They have to follow the rules that are set up. They have to set aside money outside their normal budgeting process that is going to pay you the money for the rest of your life. When you die, they get the money. It does not go to your beneficiaries. So they're going to get the money when you die. I sometimes joke with them that I don't want to go to dinners with them because I don't know what might happen to me at the dinner. So skip that. You can defer the start date. You don't need to get it now. You may say you want to get it later. Again, this would be a great thing for that Berkshire Hathaway stock. Cash flow, they're going to pay you 7.6%. And there's no volatility in the stock market because it's locked in at 7.6. Okay. However, the important part of this becomes part of this. So if I gave $500,000 as an example, and in this case, we're going to say that would give me a tax deduction today of $176,000. That makes it worth itemizing because that's a great little deduction. And it's the current year plus 5 more years after that. And that could save you, in this case, they're saying $56,000. Incidentally, this example is out of a thing called Crescendo. That's the software that runs all these analysis. It's the main one that a lot of people use. So that's what these examples are. That's what I went and licensed and took courses from them and all kinds of stuff to figure out how to do these things. In this case, I'm going to do this for Bob, and Bob is 80 years old, my friend at the 7.6%. So annually for $500,000, he's going to get $38,000 for the rest of his life. At his age, he'll get back about $440,000. Doesn't fluctuate up and down, 7.6 out there. The important part is this. Well, one, he's getting that money. Of this $38,000, $34,000 of it is tax-free because it's return on his investment. So his 7.6 after tax earns 12.2%. Not easy to get a guaranteed return of 12.2% for the rest of your life. Okay. Now, if you were 85 or 90, it's even higher in terms of what's there. So you could say, I want payments on a quarterly basis. That's fine. But know that this will be earning 12.2% for the rest of your life. Again,
you're talking about this charitable gift annuity outside of your IRA account. So,
yes.
Yeah. So this is not from your IRA. This example, this is from outside.
So outside, you've got a brokerage account and you've got, nice gains. Your Apple stock that you hold personally, could be put into here and fund it with something like Apple stock. We'll show later on how they do tie back into your IRA, but that's later on. Okay.
And when can you do this? Anytime. It's
Friday. Probably if you call Chapman, you could get it done by the end of the day, but I wouldn't recommend it because you can think about it. You can do this at any age.
Yeah.
The issue is you back up here. There it is. So know that I'm using 80. At 65, that's 5.4%. I would almost argue that it's best to be 75 or above, but 65, that's not a bad return. And then after tax, it will be higher. But because you have more years to go through, you won't get as much of a lift. If you did this at 90, you're getting a very nice rate of return after tax.
So somebody who is philanthropic,
yes,
and is looking for to increase their cash flow,
yes,
they should run the numbers.
Yes,
see whether or not this works for them.
Right. And running the numbers is very important through all of this because it isn't just, this is how much I have in my brokerage account that I want to go fund this with. Are you going to need the money in your brokerage account later in your life? One of the examples that comes up in here is I want to give my house to charity. So you can do that now, get a tax deduction now. But if later on you're going to need to move into assisted living and you would need to sell your house to be able to do it, then don't give it to charity today. So that's part of running the numbers, is seeing what all this adds up to.
I had a CEO of a corporation got a bonus at the end of the year, and his mom needed some income.
Right.
So instead of giving her money, just cash,
Right,
because that doesn't give you any tax advantages.
right,
And he wanted to make a charitable donation.
right,
He did a gift annuity for his mom.
yeah,
So his mom was 90 years old at the time. And so he received the income tax deduction for a 90-year-old.
right,
She received the income from the charitable gift annuity for the rest
right,
of her life.
right, right.
It
Now,
just,
remember then, when the 90-year-old passed away, at any age, the money goes to charity. So
yeah,
he had to know, I'm fixing mom up for life, but after life, I don't get it.
right.
So it's,
But he got a substantial income tax deduction,
yeah,
and he made a wonderful gift to his mom, and he made a wonderful gift to the charity.
and so it solved all of those various pieces
Yeah,
as you go through it. And that's, again, it isn't just, well, philanthropic or it's something else. It's what are the pieces that can work together to do this?
Yeah.
So a donor advice fund now is a new thing, and it's been around for a few years, but it's becoming much more popular. It's sort of like having a private foundation, except you don't have the overhead and the restrictions and everything else. You give money either through a community foundation or a brokerage firm. Ours happens to be at Schwab. You set this up and you give them money, and it's a charitable deduction. So if you itemize, you can still take the deduction. Put the money into it, and then you decide when you want to distribute it out. Generally, it's a low dollar amount to open them up. It's not that expensive. It's a good tool if you bundle. Bundling is, if I took a standard deduction, and that's, I think, 27,000 now or something like that each year. If I wanted to give to charity, and if I did it over 3 years, if I could bundle those together, I'd get a good tax deduction. But I don't want to give them the money now. You put it into a donor advised fund, it earns some income while it's there. And then over the years, you get a hold of them and say, please write a check to so-and-so. I mean, Noel was just on the session that we talked about with charity. A couple of weeks ago, my daughter called up and said, Dad, because they've been funding our donor advised fund. They use it from the company. They put money into the donor advised at the end of the year because they don't know who to give it to yet. And then they do it. So please get hold of Schwab, have a check written to Ronald McDonald House for $7,500 for part of the gala that they're coming up with. They don't get tickets for it, but this was something else. And so, yes, in fact, this morning I got the confirmation that Noel has cashed the check. So yes, but there's a perfect use for a donor advised fund.
Yeah, it's one of those things. This is that you can also leave monies in a donor advised fund and have your children determine which charities receive the funds. And so you're giving them an immense amount of influence in the community. And again, you get the pleasure of watching them try to figure out what charity they want to give to.
So in our case, we have a charitable remainder trust, which we'll talk about in a couple of minutes. When we pass away, all the money that's left in it goes to charity. We've specified a certain number of charities that get half of the money. The other half is what Pete's talking about. That's where the donor advised fund came in. So there will be hopefully a nice amount of money that goes into that donor advised fund, and our daughters are responsible for it. They can't have the money, but the legacy is they get to decide then where they want to support in charity, or our granddaughters, because it just stays there and keeps going along. In a private foundation, you're required to pay out 5% of the money every year. In a donor advised fund today, you don't have to do that. You can give out all of it. I mean, when we told the girls that's what we were doing, our daughters paid to open up our donor advised. And they've been using it, but they churn the thing and spend most of the money every year, which is lovely for it.
Yeah. Orange County Community Foundation
Yes.
Really supports a lot of the local
Yes.
smaller charities
Yes.
here in Orange County. Schwab has a donor advised fund.
Yep.
Fidelity has a donor advised fund. So you got lots of choices where you can go, but the concept of the donor advised fund is similar to a private foundation.
Right. And two things about one, a QCD, as I said before, you cannot put the money into a donor advised. So I can't take, this is my entire RMD, put it into my donor advised. Today, you can't do that.
Hopefully that will change in the future.
It may. Some people view donor advised as a holding point for people, but that's fine. So yeah, hopefully they will pass it if Congress agrees on something. The other thing is it's called a donor advised fund, because I can't send them a note and say, please write a check to my brother. No, two problems. One, I don't have a brother. Second is that isn't a charity. So when I say give the money to the Ronald McDonald House, for instance, I give them the tax ID number for that 501c3, and they're able to go in then and say, okay, that is a valid charity for a valid reason. And it doesn't say, I want tickets to their gala. No, then they'll do it. So I can't order them to pay. I can only advise them to pay.
And most will follow the advice. And by the way,
as long as you're following the rules, they're going to
yes,
do it.
Yeah. And you can even go international too. So you're not even restricted to the US.
Right.
It's a wonderful way, another methodology to help your kids learn about money.
Right. So let's talk about IRAs and accounts. How do you deal with those accounts with your heirs? Issues to consider. Number one, before the Secure Act, you could pass your IRA to your child and they could spread it out over their entire lifetime if they were not spending it the next day. Now, under the Secure Act, there's a restriction on how long that can be. Spouses don't count. They get it and they're unlimited in terms of that. There's some other rules, less than 8-year difference in age, imminently going to die, whatever else, those are different. Otherwise, it has to be dealt with, taken out within 10 years. So what used to be the rollover now is a 10-year period of time. And they have to take out all or part of it out but within 10 years, take all of it. So they could take 10% a year, that's fine. Or they could take all of it now or all of it at the end, but they're going to take it out. Remember, it's going to come out as ordinary income. The other thing is there is a kicker in here that if I gave my daughters my IRA, they would have to take out a required minimum distribution because I do. So once that triggers on the individual, that affects whoever gets it. We talk a lot about kids and what they do with it, and would they take the money out now or would they keep it invested? What would they do with it? And how's that going to be handled? We were chatting with somebody a while back, and her mother had passed away and her father inherited the mother's IRA account, which he immediately closed and bought a Porsche because she wouldn't let him have a Porsche. So he used her IRA account to fund his Porsche. Then he discovered it was taxable and didn't know where he was going to get the money to pay the tax on the Porsche. It wasn't on the Porsche. It was on the money that was taken out and what was going to go on with that. So that's part of what's going on in terms of how you handle this and the kinds of issues. But Pete incidentally is keeping track of the Q&A.
Yeah.
Look down, Pete. There's one there.
Yeah, I do. And we'll get you there for a second. But again, it resolves problems. If you have a special needs child, you may want to take a look at this. If you've got an outlaw that you think may tap into your IRA, this is something that you may want to look at. If you have somebody who's in bankruptcy, this is something you may want to look at. So there's some real practical issues that you can review, and this can possibly solve.
And so, as it says at the bottom, you can do this testamentary. So after you pass away, your trust, your will, whatever, you're going to say, I want to establish this with the money. So you could put that into a QCD. You could put that into a trust, as we'll talk about in a little bit, charitable remainder or something else. So that doesn't limit the 10 years. You can then stretch it out to a longer period of time. And that's how you can go through with some of these issues. So let me show you an example. Here's a testamentary trust, $500,000. Let's say it's out of an IRA account. The creative kid, as I facetiously refer to him, gets nothing today. Instead, the 500 goes in, and over his lifetime at 45, he will get out, by estimate, $1,346,000. So they're going to scream, no, I want the money. Well, actually, they're going to make more money leaving it in here, because if you're only paying 5%, it's going to grow over time. So they may be screaming at you, but they can't cash this thing out and take all the money now. But they're going to receive a really nice income for the rest of their life. Here's why some of that becomes important. Use the example before, but I think it's a good one. Let's say the estate is $2.5 million. The IRA is $1.5 million, is 1.5. The house is $1 million. Frequently, the IRA is either your largest or your second largest asset. So you passed away. The kids look at it and say, "We get the house because we get the IRA because it's $1.5 million. That's wonderful." They get it. I'm going to say they may pay $550,000 plus in federal tax, almost $200,000 in state tax, which means they're going to get less than half. They're going to get about $745,000. The charity is going to get the $1 million because they got the house. Instead, what should happen is the charity gets the $1.5 million. They pay no tax on it. They're really happy with you because they got the $1.5 million. The kids today step up in basis on the house up to $1 million. So whatever you had as it, when you die, it steps up to the current market value of the house. The kids can sell the house today for $1 million, pay no tax, and net $1 million out of it. It's not intuitive. It's sort of, wait a minute, that seems backwards. Yes, it is, but it's because of the step-up basis in the house. And that's where some of these things become important and how you look at them and where they go.
Yeah, when I was working for a number of charitable organizations, Long Beach State University, the Red Cross, 95% of the individuals that were giving through their estate plan would give it through their trust. Take a look at your IRA, annuities, those things that do not get a step up in basis,
right,
and upon death. Those are the assets you want to give to charity and then leave the assets in the trust to the kids.
Yes. It's not in this presentation. It's really more on the money side, but Pete mentioned something in there that I just want to touch on. In your in your IRA, your bank accounts, whatever else it happens to be, you can set up a beneficiary designation. Who gets the money? Now, again, Pete said, do you give it to the kids? Do you give it to your spouse? Do you give it to your trust? How do you handle it? Do you set up a testamentary trust for it to go into? That's really important to keep a handle on, whether it's your IRA account, your brokerage account, your checking account, whatever it is. Our family ran into a situation where a family member was living with somebody who said, "You get all my money, you get everything else. No problem. No trust, no will." Dies, his life insurance policy goes to his ex-wife because he never changed it, not to the current person he's lived with for over 10 years. Oops, just never changed it. So those are real important to keep up to date. Next thing we got to talk about. So charitable gift annuities are really simple, very inexpensive to do, but they're limited. You're going to get this much money because of your age, this percentage for the rest of your life. Now you can ladder them in and put more of them in, which that's not uncommon to do because the older you get, the more money you get out of them. A charitable remainder trust is much more flexible because you control the pieces and you run the numbers and say, what do I want this thing to look at? So let's talk about a charitable remainder, or what's called a lead trust. This works best if you get assets that have significant appreciation in value. Berkshire Hathaway stock, the office building we owned, the rental property you own, whatever it happens to be. This is a great way.
And the value of the asset is $300,000 or more.
Very true. Thank you. Because it's not, down here in the Bible show, it's not cheap to do these. This isn't an internet thing that you do and I'll just type out the form myself and finish it. No, don't do that. You're in litigation. Your kids will be in litigation forever over that one. The advantage of it is it doesn't remove the capital gain. It defers it over your lifetime, which is far different than having to write the check there now. The other thing that's important, and it's something that when Pete and I first talked about this, you don't have to put the whole thing in. You can put in part of it and the rest of it you take out as cash. And I'll show you an example of how that works as we go through. Key thing in a remainder or a lead trust is who gets the money when. In a remainder trust, you get the money now, the charity gets the money later. In a lead trust, the charity gets the money now, and your heirs or your beneficiaries get the asset later, but without taxing on the appreciation. I have Google stock as a founder. I put it in here as a lead trust. I will pay money for a period of time, 10, 20 years, whatever it is, but then it's going to come out at a different tax rate when I take it back out. Lead trusts aren't as common just because you need to have a whole lot of expected gain before you would go ahead and do it. The other part of it is that in our trust, we have a CRUT, Charitable Remainder Uni Trust, which means that sort of like your RMD, at the end of last year, what's the balance in the trust? And we have a fixed percentage we get of that over the next year. In a Charitable Remainder Annuity Trust, you get a fixed dollar amount every year. An annuity trust can run out of money. Mine, the amount just gets smaller. Never runs out, but it gets smaller over the time, or it may grow. I mean, you don't know what it's going to do. And in the case of an annuity trust, it's not going to grow or increase or decrease because it's a fixed amount. So those aren't as popular. You specify the charity you want to give to, but unless there's some reason not to, you can change the charity at any time. Sometimes, let's say a university or a hospital may say, we'd love to help you do a charitable remainder trust. In fact, we'll provide the legal support, we'll provide everything else, but you can never take our name off the trust. Your choice on whether or not you want to go with that. In our case, we've changed some of the charities that we had on our half of the money. Kids still get half of it in the donor advised. On our half, we've changed it because of some changes at the charities, which we didn't agree with. So we changed that by a simple little amendment to our trust. Didn't even have to go to the lawyer, just type it up, stick it in with the documents, and there it is. We notified the people who were being left out, but it's that easy.
Donna's going to show you an illustration just a little bit.
Yep.
But think of it as a box, and in this box, you're placing the asset. And this box, if you have the remainder as a charity, everything that happens inside that box is tax-free.
Yes.
So the only time it gets taxed is when it goes to the beneficiary. And so it gives you allows you to be very creative as to how you want to handle things. And give you one practical example. A fellow here in Laguna Beach, he got diagnosed with a brain injury, but it didn't. He couldn't drive any longer, but it didn't impact the rest of his life. He could still go on vacation and et cetera, et cetera. And he had a couple of different properties that he was renting out. What he wanted to do is say, hey, my life for the next, by the way, he's still alive. My life right now, what I want to do is travel. And I can't travel with being a landlord. And so what he did was put the properties into the box, but he kept enough cash outside of that box.
Right.
And so that he had cash and he had a cash flow and he didn't have to worry about his tenants.
Right.
And
right.
Don, I think you're going to show that kind of illustration in just a little bit.
The other thing about this, and we talk a lot about when my wife and I die, the rest of it goes to charity, because we didn't set up this near the bottom down here. This can be for a fixed period of time. I could say, I just want to do this for 20 years and then have it go away. Or I can say it's for my lifetime, or both. So I'll show you an example where it's, and I like to say that Pete, last century, set up a trust for someone that paid the gentleman and his spouse during their lifetime. And then after they passed away for the next 20 years, paid their heirs the money that the beneficiaries received the money. The 20 years, it then went to charity. And Pete set that up last century. Okay. Anyway, you need a lawyer to do this. They're not cheap. I mean, whatever it might cost you something, it's going to cost you
anywhere between $3,500 to $5,000.
And could be higher depending on how complex this thing is. And that's why you don't do this for 50,000, because you can set this up with the QCD. For 50,000, don't do it. I mean,
No.
it's not worth doing that. Okay, let's look at some examples. So if I had property, let's say 500,000, cost was 60, capital gains 440,000. If I gave this to charity in a charitable remainder trust, this case be a $230,000 tax deduction today. If I do this after I die, that would go to the estate, which probably isn't needed. So today I get the 230,000 over my estimated 15 years, because nope, not gonna do it. This couple were in their 82, 81. So they're saying over about the next 15 years, they're going to receive basically $500,000 in income back. So in this case, I set it up, and this was a choice. This could be variable. It has to be more 5% or more. Can't be more than the calculation that Crescendo did in doing this example. Make sure that a proper amount will go to charity in the long run, per the regulations. So it would max out on how much. Ours could have been more than we could have gotten. We said we don't need that much. In this case, I set it up at 7.5% for 2 lives. After tax, that's 8.8%. So just as a note. The other example, and it's one that Pete's alluded to. So let's say this is $1 million item, 900,000 tax deduction. There's going to be a tax deduction out of this for the charitable giving, but in this case, they wanted money out. So there's a thing called zero tax net. So on this $1 million item, they could take out almost $300,000 in cash. The rest of it at 6%, roughly $700,000, comes out, and now you're going to have that as income. So it would pay you $1.2 million over the next 30 years because they were younger. So that's what charity will get, but they're taking out almost 30%. The difference is you have capital gains on the gain. You have a tax deduction for the charitable gift. So they equal out. Now, I'll be honest and tell you, they may not equal out in the same year, because you may not have this much of a deduction to take, but over the 5 or 6 years that you have to deduct it, they should probably offset. So in this case, here's your example, takes out almost 30%.
Yeah, that's why you need what we call run the numbers.
Yes.
Run the numbers. Give different scenarios. What if I take 40% out, or what if I take 10% out, or what if I do add 5 years of income to my children? What if I'm not worried about the tax deduction? I'm just would like the growth. Lots of different scenarios. And you need the software, the computer software, to do these scenarios. And I think probably that is why most attorneys, financial advisors, CPAs just aren't aware of the flexibility that these things can provide.
So what we say, what Pete at the beginning said, do I charge people for doing this? So what we do is we run the numbers for people. So if you say, hey, here's what I've got, here's what's going on, what would it look like if I did this? We've had 2 situations where the people wanted to give money to their alma mater. And the alma mater was saying, oh, this is what we'll do. Here's how we'll handle the charitable remainder. And they're going, would you run the numbers for me? Because you're not emotional about taking the money, and tell me what it is they're trying to get from me, and see if I want to do it and give them money, or let them do it, and now I'm restricted in where I go. So there's a lot of issues like that go on in here. So another example in here, for instance, is here's a situation where, in this case, they're going to get a $500,000 item, going to get almost a $200,000 tax deduction for doing it now. It's current for 2 lives, plus in this case, I just said 10 years. I believe you can go out 20. So that's the situation that we have in this particular case. In this case, I chose in the software to take 5% out. That's the minimum that you're allowed, which means this is probably going to grow statistically, because if you're invested in the market, it's probably going to get you a growth if you're only taking out the 5%. Okay. The estimate is it'll take out over the 25 years, because it's your life plus the others, $700,000 is going to come out of this 500,000 gift. Income for both lives plus 10%. What if I change it to 7.5%? Now there's more money coming out which means my tax deduction is less. It went from 199,000 to 126 because I'm taking out more money now. Changed how much you would come out over the lifetime, but I got more money coming out today, and that will continue over the lifetime, which means this is going to reduce the size that the charity gets. And in fact, they'll probably get $750,000 at 5%. Instead is 780 roughly if you take 7.5. So it doesn't 50% increase? No. It increases how much you'll take out. Yes. Is it a lot? No. Run the numbers. Now, I'll tell you we've run the numbers for people who say, listen, my mom owns 4 rental properties and we're tired of it. We want to get rid of it. Should we set this up in her name? How old's mom? 95. How healthy is mom? Not very healthy. Wait until you inherit it and do it then. Because to me, you're going to pay money and do all these things. Mom may last 5 more years. I don't know. I'm clearly not a doctor, but think about the practicality of what you're doing. So running the numbers doesn't automatically, yeah, do it now, go. No. It's what's important to the individual. We talked about remainder trust, but there's actually 4 different types of charitable remainder trust. One is standard. I put something in and I immediately get money starting to come back out. If I had the infamous Berkshire Hathaway stock and I put it in here, that can be sold immediately and start paying out money to me on my quarterly payments out. That's one. What's called a NICRUT. I'm 45 or 50 years old, earning really good money, getting that bonus that Pete talked about. I want to set up a remainder trust that's going to pay me later more money. So I want my charitable remainder trust to only invest in municipal bonds, non-taxable items that aren't going to give me any income for this time, because you go through what's called a 4-tier accounting. This money came out taxable, this is non-taxable, this is capital gains, whatever. So I'm planning for retirement, but I need to do something with this stock that I have now. We had one situation where someone had, in fact, been one of the early people at Google, weren't able to sell the stock easily because of being at Google, but by putting it into a trust, that was different because the trust could then sell it and diversify the portfolio. Then they were able to immediately take out money. A NIMCRUT, catchy names, is same as the first one. I wanted to save for retirement. But you know what? When I retire, I really want to catch up a whole lot of money at the front end. That's fine. You can do that. The other is a flip trust, which is what ours was. We put an office building into the trust. Timing-wise, in hindsight, maybe I would have changed it. We put it in November. We got a really nice tax deduction that year. But the building didn't have the cash we would normally get out of it. It had income from rent, but it wasn't as much as we'd take out. So what we did was set it up as a flip so that until the building sold, we didn't get full distribution. When it flipped, we started getting distribution. That was our choice as to how to handle that and where to go with it. A lot of this depends on the income. For instance, if I did this NICRUT thing, I'd get a tax deduction today, but I may not be getting income from it until later on. So a lot of this is run the numbers, as Pete will keep saying, is terribly important.
And what are your goals and objectives? What are you trying to
remember that
accomplish?
list of all these things? We'll come back to
Yeah.
it in a minute. But what is it you're trying to solve? What's the issue? What's the problem? This is an important one, and I did this live a couple of years ago for some presentation. I thought there was a woman in the back of the room that was going to faint because they said, okay, here's the thing. Timing is an issue. If you sell whatever the asset is and then give to charity versus giving it to charity and letting them sell it. It's just that simple as to who went first. $1 million asset. Basis is 100,000. Gain is 900,000. 40% capital gains tax, and that's the high end with some other fees and things into it. You'd have to pay at $360,000 in capital gains, which means you net after tax $640,000. Okay. If you took the 640 and my friend, the 80-year-old, you would then say, I'm going to give that to charity for a charitable gift annuity. you'd get a tax deduction of, let's say, 224,000. Tax rate, 35%, that just saved you $78,000. As an 80-year-old, remember, I get 7.6% of my annuity. I'm going to get, for the rest of my life, $48,600. If instead I gave the asset directly to charity, they sold it. So in my case, for instance, we put our office building into the trust. The trust then sold it. Now, we happen to be the trustees of the trust, so we could say, this is what we want to do and what's going on. No problem. But in this case, if you gave it to charity directly, the charity would get $1 million. My tax deduction at 35% is going to be $350,000. I'm going to save $122,000, not $78,000. So I just had an immediate tax deduction of tax recovery of $44,000. 7.6% of $1 million is $76,000. That is every year $27,000 more for the rest of my life. That's over a 50% increase by just giving it to charity first and having them sell it. And incidentally, the charity's happy because they get an extra $360,000 because you didn't have to pay tax on it. We've alluded to this, and I'm going to bring us back to us. What's the problem you're trying to solve? Because is it just giving back? That's a wonderful reason. Income tax, capital gains, estate tax, cash flow, investment, beneficiaries. Whatever's there probably is a solution in a charitable giving mode that lets you go through and do that. So that's why I brought us back to here in terms of think about why are you doing this and where are you going?
Can you imagine the individuals who made a wild bet on Bitcoin and, you know, within less than 2 to 3 years, just made a ton of money, and they hung on to it? You know, when you think you're at the top or you made a substantial amount, you could put it in a charitable remainder trust and then sell it tax-free and then diversify your portfolio.
Or if you think, oh no, but it's going to keep going up, put half of it in the remainder trust.
Yeah.
And then sit on the other ones and watch what it does.
Yeah.
Because of the diversification aspect. Let me do one more slide. We talk about the software. This is the screen on Crescendo when you go in and say, what do I want to do? So for instance, here is your uni trust plus a term of years. So that would be when I did that one that said, do this and then do 10 more years. That's the one I'd select. He's going as an annuity. I mean, all of these things are options. That's why I don't recommend you sign up for Crescendo, but feel free to ask us about it and say, run the numbers for me and take a look. And as an example, when I first did this to do our charitable remainder, David Moore at Chapman actually ran the initial, probably Lindsay ran for him, but ran the initial numbers for us to take a look at. And that's when I looked at it and said, I want more. And that's what ultimately gave me, go get Crescendo and learn how to do this thing. But I don't recommend that people do it. And incidentally, within each and every one of these line items, there are choices you have to make. It's not just that, those are that's just the beginning of it.
Well,
Thank
you know,
you.
Jacqueline Kennedy, she left a lead trust for her kids.
Right.
You know, I mean, Bill Cosby, when he made a major donation, he did it through a charitable remainder trust.
Yeah.
You can sometimes, we had a college professor who wanted to, every year, his entire family spent time in Arizona on one of the reservations. And so he wanted his charitable remainder trust also to be able to donate, almost act like a private foundation, to distribute money to different aspects of the Indian reservation.
Right.
There's, you know, there's a lot of things that you could do, and the thing of it is that it's so there's not a whole heck of a lot of professionals who know about it, because as soon as you hear charity, you're thinking you're just giving away money. And, you know, hopefully what you saw today, and I thank you, Don, for doing such a wonderful job on this, that there's lots of financial reasons why you may want to consider doing one of these plans, especially if you own rental property. Gosh, you
Big
know,
thing for people.
yeah, the numbers sometimes really
1031
look good.
exchanges were what, because we did it too. I mean, we had one office building, sold it, and bought another one, transferred the gain over, which is why our capital gain in the end was rather large, because we had started over here and gotten into bigger building, which is what a lot of people with rental properties and others have done, the 1031s, which were great. And it used to be you could do that on your home.
Yeah. Wonder if we go and to the
Before we do
page.
that, however, I'm going to give a plug to us.
Okay.
So if you want to, and on when you sign in, you got your notice of here's how you get into Zoom, but it also lets you know where all the visuals are and a copy of this presentation. If you go into this area and look under the workshop articles, I wound up, leave me alone in a dark room and I'll write something, a booklet on estate planning, charitable giving, and financial planning, sort of following along with the seminars, but I expanded on the charitable giving one. Gives you more ideas and more thoughts in terms of what's there. So I'm going to stop sharing and have it be Pete and I. Hi, Pete.
Yeah. Hello. My wife is a CPA, and what we see is that most individuals, when they sell a highly appreciated asset, do not know the tax consequences until after they sell.
Right.
And so if you have an asset, that's why we ask you in it's your estate area, you know, write down all of your assets, figure out how do you have title to those assets. If you have an insurance policy or an IRA, who is the beneficiary, designated beneficiary? What is your cost basis in your asset, and what is the market value? And because, you know, a lot of times as a professional fiduciary, we have to look at someone's assets and maybe they need additional cash. So we look at what can we hold off until after death because of the step up of basis, and what asset can we use today from a tax point of view that's most efficient. And taxes play a huge part in what kind of return that you get. And remember, you can't take this money with you. So
my wife had breast cancer years ago, and after treatment was really down from the whole thing. And there was a facility that she'd gone to over in Arizona. And so we got to know them very well because she recovered wonderfully from that and all things were good with it. And so we'd gone back and forth just to visit over there, and I was chatting with this one woman, and something came up about these charitable trusts. In fact, she wanted to do one because of something she had gotten. And the issue came up of, here's what you can do and you don't pay tax now. And she suddenly just lit up, and I went, what? And she goes, the facility gets an abnormal number of lottery winners. It's not an inexpensive place to go to. And they go, now that I have the money, I'm going to go do this. And she said she sat down with a lady one time who had just won the lottery. And the lady said, you know what? We paid no tax on it. And the lady I was chatting with went, I don't understand it, but I think I just figured it out. Yes, she put it into a charitable trust and will get money over the years and beneficiaries and split it out how she wanted to, but didn't have to pay tax today on it.
No, Noel, if you're there, you're
Noel's still here.
To come online, because you deal with a lot of donors, and you know you're a nonprofit expert. But so what do you do when somebody comes up to you and says, I would like to donate to the Ronald McDonald House, and how do you handle that kind of conversation?
You know, first of all, this is why we are so privileged to sponsor, because you really are a public service to our community. And for us, we don't have the experts, and we've had the consultants in the past that usually guides them. So we don't have, and we really follow similar pattern where there isn't an attorney that we do, right? We suggest, and then that they kind of vet on their own. But Pete, we don't.
You need some hand.
Yes, we have the estate planning. You're on the legacy, but we.
Yeah, you need some hand holding.
What I'm learning, and this is what we try to share with folks.
Yeah. People need hand holding. This is a strange area. And to give up, I think one of the biggest things for people is to give up the control. Yet what they don't understand too is in a charitable trust, you could be your own trustee. You just,
we are.
You can, it's in a separate account, but Don gets to decide as to what he wants to do. He could even change the charities if he wants. You can make these things so flexible, but it is not everybody in the profession, are familiar with this. And you don't want to be as a CEO of a charity, you can't advise them, as to, hey, what to do and the tax consequences and that type of thing. So it puts a donor in a kind of a confusing spot, and we should somehow try to make it easier for them to do so. Do you find that most of your donations come in during Thanksgiving and Christmas?
Yes. So those seasons throughout the year, right? It's the Thanksgiving, the holidays. People are mindful, and there are people, not only are they looking to celebrate, they want to be mindful of those who are less fortunate. And specifically then for us, they feel blessed, and they're mindful of not everyone is in the same spot to celebrate. And particularly for our families, the last place they want to be at is a Ronald McDonald. They want to be home, right, for the holidays. And so that, yes, we try to do the creature comforts and whatever we can to make it a home away from home, but ultimately there is no place like home. So
you're having trunk or treat.
We are having trunk or treat with it. We have, and I do wanted to share why are these, for the families that we serve, when you have a critical ill child, what we find is many of them lose the time of day of the week, seasons. And why it's important for our charity, these milestones, it kind of sets people back into the rhythm, because families will forget it's Halloween, it's Christmas, it's Mother's Day and Father's Day because of what they are. But what we realize is the children don't forget, right? The siblings still forget. It's still Halloween, right? Yes, that there's important stuff. So why the charity finds it really important to celebrate these milestones throughout the year. It really kind of keeps the families on track.
But see, we're sitting here talking about the tax deductions, the types of plans that you can do. And you, as a CEO of Ronald McDonald House, are focusing on the family and the kids, and which I love, because that's where your heart and soul should be. But during the donation period, most people just write you checks, right? I mean, how often do you get a mutual fund donated or a stock donated? Is it
it's relatively regular as far as like the stock, people sell their stocks to make the donations and things like that. But
they sell the stock, but they should be giving you the stock for you to sell.
Oh, yes. We have that as well, right? So then they give us the stock and then we sell it for whatever. And then they have a sense of what it's valued, right? To say, I want to make this donation, and right now the rate.
But the vast majority of donations are cash. Is that correct?
They are.
Yeah, it's a check. Yeah.
Yes,
are you seeing more QCDs donations?
I'm not sure if I'm seeing more.
And one of the interesting problems you face is you could get a check sometime during the year from Schwab. But you don't know that it's a QCD.
That's right.
It may or may not even have my name on it, but you don't know what it is because it isn't defined as a QCD to them. And that's where I can understand where Noel wouldn't know necessarily what that was. So we're hitting on our 11:30, so we're going to end this guy. So Noel, if you want to turn off your camera, bye. So Pete, congratulations on week 5. So we have gone through on financial.
One more week.
What financial estate literacy? This has been It's Your Estate. We've been talking week 5 about charitable opportunities. Next week, we will be talking about estate administration, which I know all of you have put on your calendar as something you're really looking forward to. The issue is, however, you should, because it's doggone important. And you can't just say, I'm going to give it to my oldest son to be responsible for. And that's a miserable gift to give to your kid.
Yeah. And you may, whoever you named in your, as your healthcare agent, or as your executor, or as your attorney, in fact, or as your successor trustee, you may want to make sure that they take a look at the estate administration, because they're the ones that are going to be doing it. And so we try to make it very practical, so that we know that most of you are going to use a family member in those positions.
I have to admit, Pete, I believe I truly have now gotten older. Last week, we went to Santa Barbara. And before I left, I got a copy of my advanced healthcare director, Jean's advanced healthcare director, and my sister who lives in Santa Barbara, and hers, and took
in your
them
glove
with me.
compartment.
Yes, I took up with that. God, I'm getting older. Thank you, Pete. Thank you, everybody, for joining us.
Thank
same
you,
time,
Noel.
same place next week. And have a good time. And
Take care.
have a good Halloween. Bye.